Hello, my name is Troy Adkins, and I am the founder and owner of Adkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. residential housing market during the third quarter of 2019. During the third quarter of this year, the Trump administration's release of its first formal plan to overhaul the housing finance system and begin the process of removing Fannie Mae and Freddie Mac from government conservatorship, and the actions of the Federal Reserve as part of its Federal Open Market Committee operations were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview in mind, let me now turn your attention to the primary housing topics for the third quarter of 2019. In September, the U.S. Department of the Treasury released its first formal plan to overhaul the housing finance system and begin the process of removing Fannie Mae and Freddie Mac from government conservatorship. The objectives of the Housing Reform Plan are to create a limited role for the federal government in the housing finance system, to enhance taxpayer protections, and to increase the role of private sector competition. Fannie Mae and Freddie Mac have been under government conservatorship for the past 11 years. As of the end of Q2 2019, Fannie Mae had made $181.4 billion in dividend payments to the Treasury, and Freddie Mac had made $119.7 billion. Those amounts exceed the amounts drawn from the Treasury during the financial crisis by a collective amount of $109.7 billion. Fannie Mae and Freddie Mac have been very profitable during the past several years, thanks to higher fees they charge to lenders, higher quality loan portfolios, and the overall strength in home values. With this in mind, the Housing Reform Plan does not include ending the ongoing net worth sweep of all of Fannie Mae and Freddie Mac's profits, which is part of the Treasury's Senior Preferred Stock Agreement. Instead, the plan allows the firms to retain more earnings and thereby grow its capital buffers. The Housing Reform Plan sets forth a proposal that is less focused on recapitalization and more dedicated to comprehensive housing reform. The Housing Reform Plan does not recommend a government guarantee, but supports legislation that authorizes an explicit, paid-for government guarantee of the payment of principal and interest of qualifying mortgage-backed securities. The Housing Reform Plan appears to be in line with that of Senate Banking Committee Chairman Mike Crapo. Senator Crapo's priorities are to establish stronger levels of taxpayer protection, to preserve the 30-year fixed-rate mortgage, to increase competition among mortgage guarantors and to promote access to affordable housing. Senator Crapo's plan also calls for a backstop on mortgages, which will be paid for by private guarantors, private companies backing the loans, a securitization platform operated by Ginnie Mae, Fannie Mae and Freddie Mac serving as private guarantors, the sell-off and independent operation of Fannie Mae's and Freddie Mac's multifamily businesses, Ginnie Mae providing a catastrophic government guarantee, and Ginnie Mae operating a mortgage insurance fund. The original Johnson-Crapo bill called for the elimination of Fannie Mae and Freddie Mac. It would have established the Federal Mortgage Insurance Corporation, and it would have provided an explicit full faith and credit guarantee on covered mortgage-backed securities, following a 10% first loss credit support provision from private capital. The bill also called for guarantors with a regulator and standardized policies, practices, and documentation for mortgage-backed securities utilizing a common securitization platform. The Johnson-Crapo bill was not supported by key Democratic leadership, including Senator Schumer and Senator Warren. Based on an evaluation conducted by Adkins Capital Management, an evolution needs to take place from one end of the housing policy spectrum to the other, as a transition takes place from exorbitant to minimal government involvement. Accordingly, the temporary adoption of the recap and release policy is recommended, a policy initiative that promotes a feasible evolution from the recap and release policy to the policies outlined in the PATH Act, the elimination of the implicit government guarantee for GSE mortgage-backed securities, and no explicit governmental guarantee. In addition, Adkins Capital Management recommends that investors ignore the rating agencies because they are paid by the companies that they rate. The promotion of policies that require investors in GSE mortgage-backed securities to determine the risk of investing in a GSE mortgage-backed security before making a capital investment. Access via the GSE websites to all of the underlying mortgage loan information that make up every loan in a GSE mortgage-backed security so that investors have the ability to conduct a thorough investment analysis. The prohibition of GSE mortgage-backed securities from including low credit quality mortgages. The requirement for equity investors in the GSEs prior to their placement in conservatorship to lose 100% of their equity investment. The requirement for equity investors in the GSEs following their placement in conservatorship to maintain their equity position at a non-diluted value, and to use guarantee fees held by the GSEs to increase their capital reserves. In essence, it is the view of Adkins Capital Management that the role of the U.S. government's housing policy via the government-sponsored enterprises and the Federal Reserve are too extensive to be funded by the private capital market in a material way. It is clear that future U.S. housing policy pertaining to the GSEs will have to be designed according to the way things are rather than to the way things should be. And the Federal Reserve will have to unwind its mortgage-backed security holdings on its balance sheet over a long period of time in order for private capital to take a leading role in U.S. housing policy administration. Adkins Capital Management has published a wealth of analytical information about the role of the GSEs and the Federal Reserve's role in the U.S. housing market in its quarterly residential housing reviews. For more information, please watch the movie presentations listed below. For the third quarter of 2019, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 3.8% and ended the quarter at 3.72%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. In view of realized and expected labor market conditions and inflation, the Federal Reserve elected to lower the target federal funds rate to 1.55% and 2% during their Q3 2019 Federal Open Market Committee operations meeting. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community, because a rising cost of debt will increase the amount of interest expense that prospective homebuyers will need to pay for their mortgage loan. This, in turn, will place downward pressure on the price level of residential housing in their community. As a benchmark proxy, prospective homebuyers should remember that a mortgage loan interest rate of 5.3040399% for a 30-year fixed-rate loan would require the homeowner to repay twice the home purchase price if the loan is repaid on schedule and held until maturity. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Adkins Residential Home Valuation Analyzer. Moving away from these policy issues and events, and to an assessment of the housing environment, it is important to note that for the third quarter of this year, 23 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. Newark, Los Angeles, San Francisco, Honolulu, and Miami were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 3.72% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amount. With this in mind, in order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $59,436 and $211,744. Finally, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $157,656 and $526,203. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 37 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the quarter. Oklahoma City, Wichita, Charlotte, Anchorage, and Little Rock were classified as the top 5 most underpriced cities in the index. Wichita, Charlotte, Anchorage, and Little Rock were classified as the second, third, fourth, and fifth most underpriced cities in the index, based upon their higher justified mortgage loan interest rate amount. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 3.72% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the costs of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.